SB Talks. Today is Friday, February 23rd, and as ever, I am joined by our Chief Investment Officer, Nick Ryder. Today, we will be discussing NVIDIA's bumper earnings result, a new high for the Nikkei, Australian earnings season, and the Taylor Swift stimulus effect. Welcome, Nick.
Thanks, Vinny.
We've spoken in recent podcasts about US earnings season, and particularly the Magnificent Seven. Now, the last of the seven reported since we last spoke, and that was NVIDIA. Their share price is now up approximately 400% on where it was in 2021. I think they tripled their earnings. What is your take on their reporting?
Yeah, well, it was another very strong report. They beat earnings by 10%, $22 billion for the quarter. Now, this is a company that 2 years ago was making $26 billion for the whole year. So it just shows you how far they've come. You know, the data center revenue is $18 billion, and a lot of that's coming from AI chips.
The big
their H100 chip. So it was a good report. There was a few, if you were to look for a few sort of things of concern, then you might say, well, China, there are export controls now that the US has imposed. So high performance chips, AI chips, are not allowed to be sold into China. So the China revenue was only 9% of sales versus about 22%, a couple of years ago. So that maybe is a bit of concern. And I think the other thing is just the sustainability. Obviously all these data centers are upgrading their chips now to process large language models, and that's all very exciting. But once that sort of upgrade's kind of gone through, to what extent can those sales continue? So I think
you're describing something that's almost like the new iPhone effect, where everyone goes and upgrades, and then you have a bit of a slump that follows.
Yeah, not necessarily a slump. I mean, I think
the growth cannot be continued.
Yeah. Well, one thing we did learn in the reporting from NVIDIA was they're working on the new chip, the H200, which is twice as fast as the H100. So there will be an upgrade cycle that comes through. So I think it's a great story.
It's particularly interesting because there's been so much hype and interest in artificial intelligence in the last year and large language models, and NVIDIA are seen to be the primary bellwether of how much that's taking hold and how much impact it might have on the world. And clearly their sales are suggesting that the major technology buyers, the Microsofts, the Amazons, they're betting big, and they're going double down on this.
Yeah, absolutely. And I think everyone uses the analogy of the gold rush. The people supplying the picks and shovels were the only ones that made money, and the gold prospectors generally didn't do well.
Now, it's been quite a spectacular earnings seasons, or even the last sort of 6 months in particular, for a number of the Magnificent Seven, or the Mag 7 as they're increasingly becoming known. I heard someone quoted me this morning that the combination of market capitalization of Microsoft and Apple now is bigger than the UK FTSE index, which for the once great empire, that's a pretty startling statistic.
Yeah, and just think about it. NVIDIA yesterday, their report was quite good. They went up 16%. That's $250 billion of value created in one day in just one stock. So, I mean, that's more than the value of many stocks on the ASX.
It's just a different league. But there's no doubt that there's real significant momentum behind this space.
We did have a fund manager, one of our global equity fund managers, in yesterday, and we asked them about NVIDIA, and he said it was like grabbing a tiger by the tails, which I thought was an interesting
well, they can sit there and be quite happy, because I think they made their investment in it about a year ago now, so that's certainly been a handsome payday for them.
Yeah,
you reference NVIDIA's growth there to the value, the growth over that a couple of days compared to an ASX market cap. We're entering Australian earnings season. What's your read? What are you expecting?
Yeah, we're about a third of the way through by a number of companies reporting. There hasn't been a huge amount of sort of upgrades or downgrades. At the margin, industrials and banks have sort of been a little bit better than expected.
Yep.
Probably because analysts were probably fairly conservative about those sectors coming into reporting season, and resources has been a little bit of a disappointment. So net, it hasn't had a huge impact. We're still looking for earnings to actually contract at 2.4% this financial year. back of really kind of commodity prices coming off a little bit there.
Normalization in some commodity prices.
But we have seen, I think, the number of companies beating is around 40%. That's kind of in line with historical average. The number of companies missing is slightly above historical averages, is 36%. So it's a so reporting.
Result, too much. Not enough so far to draw any major conclusions from it.
No, but what we have noticed this reporting season is the moves in stock prices after, whether companies are beaten or missed, have been larger than normal. So that's just something a bit different.
Investors are either rewarding handsomely or punishing severely companies on the results. We were talking earlier today regarding a very significant milestone for the Nikkei in Japan.
Yep, it's finally at a new record all-time high. It's only taken 35 years since 1989. Everyone talks about the years of deflation and the bubble that burst after that sort of. There was that huge Tokyo property bubble back in the late 80s, and that sort of popped, and then the market there has really been in the doldrums for many years. Seen,
the Japan have been working very hard to create inflation for decades and trying to create any form of growth. What has been the catalyst that's seen them finally get back to this milestone?
There's been a few things. I mean, I haven't dug too deeply into the individual companies, but I think there's a couple of things that have helped just excite investors about the market. One is the not China. So, China is, according to some investors, non-investable, uninvestable, just given the way that the government controls capital flows and company earnings. So
people looking to allocate to the region are finding other spots.
And Japan has strong linkages with China. So people say, well, we can kind of get China exposure by going into the Japanese stock market because a lot of those companies there have strong linkages. So it's the not China effect.
A proxy way to get a play on it.
It's the only country that still has not lifted interest rates, so it's still got it's still got QE and negative yields there. So I think that's helped as well.
Their declining population, it sort of creates a natural sort of deflationary effect. So
and the other thing is. I think it was about a year ago, maybe a bit longer, that Tokyo Stock Exchange brought in these new rules that punished companies that just sat on lazy balance sheets and cash, didn't pay out dividends, didn't do share buybacks. And so they brought in a sort of name and shame rule, that companies that traded below 1 times book value were going to be potentially delisted, or I can't remember what the exact sort of consequences were, but certainly they would be named and shamed. And so foreign investors have gone, great, maybe this is the start of a new regime where companies are more shareholder friendly, more focused on return on capital and dividends and all the things that shareholders like, rather than just, protecting their jobs. And
the traditional, I guess, things that you would associate with some of those major Japanese names. Since we last spoke, we had late last week US CPI data gave the market some pause for thought in terms of interest rate outlooks.
Yeah, it wasn't terrible, but it wasn't, I think, for example, the number was 0.4% in January versus 0.3% that had been expected. So it was slightly higher than expected. Looking under the surface, there was a bit of a January effect. So companies do often push price rises through in the new calendar year. So there was perhaps an element of that. I think the other surprise was what they call owner's equivalent rent. So we don't have this in Australia, and many other countries don't have it. But in the US, they have this thing where they ask people, okay, you own your own home. If you were to rent it, what would you pay in rent? So they impute a rent for people that actually own their own homes outright. Whereas in Australia, we just...
arbitrary.
Yeah, but it is 36% of the core CPI basket, because obviously, where you live is a substantial part of what people spend money on. And that went up. And it was driven by what they call single-family home or freestanding home prices that have kind of gone up because there's a shortage there. So People are just trying to see, well, what does this mean, kind of longer term, you know?
And how did that data release change the market outlook for when? I guess the story in the US is about when do they start cutting?
Yeah, so we've seen that, and maybe the Fed minutes that came out this week, which sort of push back on the idea that there'd be near-term rate cuts. You know, the Fed's still saying that, you know, they think rates have peaked, so they're at the peak. But what they want to see is more evidence that inflation is moving sustainably down to that 2% level before they start to cut. So I think they're just wanting to see a bit more evidence of that, and they are worried that, you know, the rally in the equity market and the repricing in the bond market was sort of undoing some of the work, their own work, and sort of preempting rate cuts that may not come.
This was always a risk, and you spoke about this previously, when the market gets carried away and suddenly you get this second wave of inflation potentially coming through.
That's right. And so, you know, I think there's still a bit of caution that the CPI and the Fed minutes sort of kind of hinting at that has seen markets wind back some of those rate cuts for May, and now we're sort of looking more June, July for the first rate cut in the US.
To not just give you unlimited credit here, but it's probably coming more in line with what you've been predicting in recent weeks, which is we thought the market was a bit over exuberant. The rate cuts were going to come, but they're probably more likely later rather than sooner in the year.
Yeah.
Let's step back more domestically. Since we last recorded the podcast, we've had some RBA minutes. We've also had some significant wage data here. How much, if anything, has that changed the outlook?
So the wage number was maybe a tad higher than what market was looking for. It was 0.9% for the quarter, 4.2 year on year, so a little bit above the 4.1 previously, and the 4.1 that the market was looking for. That was mainly driven by public sector wages, so they went up 1.3% in the quarter. Private sector wages were a bit softer, and then if you look kind of into the detail of the private sector, there's still a bit of wage growth coming from enterprise bargaining agreements that are kind of rolling over, but people are on individual contracts. There's some softening there. So for the RBA, it's probably nothing to get too concerned about. When you look at that and the weakness, for example, the number of jobs created in January was just 500. You know, so well down on the sort of 20 or 30,000 needed to keep the unemployment rate steady.
Albeit a lot of conjecture around, is that a January, a bit of a blip with people taking
January effect.
Christmas to Australia Day off type scenario? So.
Yeah, or people have accepted jobs if it don't start till February. So we're not necessarily read too much into that. But it did push the unemployment rate up from 3.9 to 4.1. So with that and the fewer job ads, you know, maybe you think, okay, well, wage pressures probably will peak and start to ease over coming months. So I think the RBA, and we saw that in the minutes, they're getting a little bit more confident that inflation will come down to target within a reasonable time frame and still preserve a lot of the gains in the job market. But once again, want to see more data. They also don't want to really rule out the possibility of another rate hike. They're not ready to do what the Fed's done and say, oh, we're kind of at peak rates yet.
Probably a tad concerned of a bit of over-exuberance if they do that. So striking a cautionary tone then. And then again, we're looking, I see a little bit of conjecture late this year, possibly some commentators even suggesting it might be early next year before that first rate cut comes. What's your take?
Oh, it's hard to know because it is very data dependent. I would say third quarter this year, you know, August, September, something like that.
But no huge potential impact to the consumer for this calendar year.
Not really. I mean, we're talking 25 basis point cut.
I think they'll be, even when they start cutting, they'll certainly be proceeding with caution unless the economic picture change fairly dramatically from where we are today. We've talked a few times on the podcast in recent recordings regarding China, a challenged economic position there, their property market, certain levels of government intervention, and now they're cutting rates.
Yeah, so they surprised the market this week with a larger than expected rate cut for what they call the loan prime rate, the 5-year loan prime rate, which a lot of mortgages are set off. So they cut that 25 basis points. We've discussed on the podcast before, these are all little piecemeal measures, just trying to put maybe a bit of a floor under the property market. But, they have this whole sort of debt deflation spiral, where this liquidity trap, where it doesn't matter how much they cut rates. If people just don't want to borrow, it's not going to make any difference cutting the 5-year mortgage rate by 25 basis points. So I think they're just hoping that prices stabilise and maybe find a floor, and it's all piecemeal band-aid measures at the margin, rather than the bazooka stimulus that a lot of people had been hoped
for. But they just can't go back to their old playbook.
No.
I've heard a variety of different numbers, and no one can be certain about how many million excess properties they potentially have, roads to nowhere. They've done it so many times that playbook's done and coming back to bite them, if anything. So they are just trying to find their way through this, a controlled economy, so they're able to manage it in so many ways. But they're shocked. Their share market is incredibly cheap relative to other parts of the world. So as an investor, again, I come back to that question: are you still happy to just sit back and watch?
Yeah, I mean, it's superficially cheap, but they've got deflation there, right? Which is not good. If prices are falling every year, then what looks cheap can be cheaper next year. So I'm not ready to dive in, and the fund managers we speak to say, there's a risk that they could get a bounce, but you need a catalyst for that, and that would be some sort of big stimulus or big, policy change.
You know what they need? They need a Taylor Swift tour. That's what China needs, I think. But this is the new stimulus effect. We've got Taylor Swift tearing it up all over Australia at the minute. Probably horrendous inflationary consequences, but God, it's worth it. For anyone that's managed to get a ticket, China needs a massive, across-country Taylor Swift tour, turn the economy around.
Yeah,
what do you think?
Absolutely. That would turn deflation to inflation. And it would bring back what people say they need, the animal spirits, in the economy.
Okay, well let's see if that one plays out. Recapping, anything changing your views with regard to portfolios at the minute in terms of your outlooks, your allocations? Comfortable with equities domestically, internationally?
Yeah, I think so. There's nothing really kind of sort of shifting one way or the other. The markets, we had a little bit of a pullback, which is probably healthy. A
little bit of steam being let off.
Yeah, a little bit of steam let off, and then but then we get some good results from companies. So it's ultimately earnings will drive the market, and if the earnings are coming through as they are, particularly in the large cap stocks, then the market continued to grind higher. So I think, broadly comfortable with a neutral weighting in equities and fixed interest.
And you are undertaking a review of the fixed income sector currently, just looking at the best place to be invested for the 12, 24 months ahead?
Yeah. So we're looking at sort of traditional fixed interest as well as investment grade and high yield bonds. Some pockets of that market are starting to look a bit expensive, particularly high yield bonds have had a really good run over the last year. So maybe for incremental risk, you'd prefer equities maybe than high yield bonds. But we're looking at it all at the moment. So it's quite a lot of work.
Yeah, quite an interesting time now to look at it with the sort of, dare I say, the interest rate outlook beginning to settle down somewhat, having a little bit more certainty around that. It's an appropriate time to sit and look at what should be the mix of fixed versus floating, credit and those other assets. So we look forward to discussing the outcome of that review in future recordings. But for now, thank you very much as always, Nick. Enjoy Taylor Swift this evening, and thank you to all our listeners.